What is going on, Future Focus family? My name is George, and we talk about investing on this channel. I got Matt joining me as always. Matt, what's going on, brother? Oh,
Staying alive, my man.
staying alive. Matt's image is kind of paused right now, but I'm sure we'll get him back. Today we got a full length show. We got a lot of stuff to talk about, a lot of stuff to address. The first thing I want to go through, as always, is the S&P 500 is currently up. It is up 0.74%. The Dow is up 0.61. The Nasdaq is up 0.64%. The Russell 2000 is up, but slightly 0.0%. Crude oil still above 110 at 114. Gold is up today. It's weirdly correlated with gold and silver, and they're both up. Silver is actually up a lot more. It's up 3.76%. We got Bitcoin up 2.71%, and the crypto index as a whole is up finally above that $1,000 threshold at 1.06. But let's get back into it. I'm loading Maddie's screen. Hopefully this will work. Maddie, can you still hear me though?
I hear you, but I'm trying to get on this computer as well.
All right, good to go. I'm gonna take you off for right now. Matter of fact, I'll leave you. All right. So the first thing I wanted to address was something I just received. This wasn't even going to be part of it, but I think it's relevant, and I put it in the title just now because I wanted to speak to this. So I'm not even sure if you know about this, Matt. It might not even get to you out there, but let's go through this real quick. All right, so a $300 monthly stimulus check may come your way. Let's take a look at this. This is fresh off the. There you are, Matt. I see you. Let me fix this up real quick. All right, so let's take a look at this and we could talk about it. All right, and any non-electric car owner knows that the price at the pump are hitting pretty hard lately. Earlier this month, they even surged to an all-time high, as you saw. Price per barrel is at 114 right now. Because Americans could wind up spending $2,000 more on gas this year, politicians are they're trying to create relief plans. The national average gas still remains above $4 a gallon. Last I saw, it was about $4.29 per gallon. At the higher end, it was at this place called Gordo, California. Gas was sitting at about over $7.39 in Gordo, California. In a statement, Representative Thompson said the gas stimulus will provide middle-class Americans with monthly payments to ease the financial burden. They're calling it the Gas Rebate Act, and it would provide a $100 check each month to both joint and single filers, plus an additional $100 for each dependent, so long as the gas prices stay high. Similar to the 3 stimulus checks that Americans already got, it would go to single people earning less than $75,000 and joint filers making less than $150,000, with the checks phasing out for anyone making up to $80,000 or more. So while there is no word yet on how the checks will be paid, a second proposal with Democratic Representative Ro Khanna of California and Democratic Senator Sheldon Whitehouse of Rhode Island seek to charge a tax on oil and gas companies whose profits have significantly risen, and use that money for checks to Americans called the Big Oil Windfall Profits Tax. It would levy a tax on each barrel equal to 50% of the difference between the concurrent price. So this is something I talked about yesterday. Gas prices. I talked about investing is right now the right time to invest in this kind of environment. And I said, no, the time has passed. If you wanted to invest in oil and oil stocks like Exxon or Occidental Petroleum, the time has passed to invest in these stocks, and do not invest in them. You can short them. Like if you're looking at 6 months out, a year out, short these stocks, but don't try to jump in there because even if they go to $130 a barrel, the risk to reward is not really worth it. But let's talk about the economic toll that this can take in a longer picture. We're already facing record inflation. We have over 5%. The Fed has committed to talking about like they've already did the first rate hike. coming May, they're supposed to be doing another rate hike that could be up to 50 basis points, which is half a percentage. And these could come faster rather than later. So, how do you guys think about this, Matt? What are your thoughts on the inflation piece right now? You're still kind of lagging, but
All right.
it's all good.
All right. Man, you talk about technical difficulties today, man.
I know.
Um,
Excuse us. Excuse us.
that's why I don't do tech stocks, ladies and gentlemen. That's why. Anyway, um, all right. So that's a lot to unpack. So we're talking about more stimulus. I don't know. That sounds like more money printing to me. That sounds like more inflation. Um, I don't think that's going to help the problem. I think creating more supply is going to help the problem. It's not a money issue, right? And that's the problem. We think that we could just throw money at something and it'll be fixed. At best, maybe temporarily, at best. But if you have a shortage, you have a shortage. And we can't deny um, the Russia's involvement in the gas industry or Saudi Arabia's involvement in the gas industry. And I want to say those two countries basically told us no. I don't want to put words in their mouth, but essentially the relations for both those countries aren't good. And I want to say they make up north of 25% of the global gas supply to the world.
Yeah.
So yeah, to answer your comment about um gas, so I definitely get what you're saying. Is it too late? I see your point. I definitely see your point. I think if you're a rookie trader, that boat probably sailed. But would I be surprised if oil or gas hits 200? I wouldn't be surprised. I wouldn't be surprised. Um, I don't think that's out the realm of possibility. Um, keep in mind we don't know what Germany's doing yet. What they're doing with their gas line, they are, from what I understand, I don't want to say 100% dependent on Russia, but a vast majority of their gas comes from Russia. So they're in limbo. They want to, and that's fine. I think they were going to play the game, but I don't know if you heard the new requirement Russia put out.
For what?
I don't know if you want to elaborate on that. Basically, they are saying that you can't buy gas unless you pay in rubles.
Hmm.
So,
Makes sense because their currency has cut in half. And if you
mm,
don't think that can happen to the dollar, you know, if we make one wrong move that the world doesn't agree with, we could be going through the same thing. This is not something that's just centralized in Russia. We could do the same thing to China. So I think China has thought twice about moving into Taiwan. I think they still want to do it, but I think they're seeing the consequences, and we're going to get into a little bit of that and see how after all this Russia stuff played out, they really, really changed their stance on the way they were viewing things in China. And that's the next article we'll get into. So let me share this real quick. All right, so let me remove this.
I'm backstage, by the way.
All right, so China may be looking to ease regulations. Is it time to invest? This is something I definitely wanted to share because we talk about China here. Um, is it safe to invest in China? 6 months ago, they were really strict. A lot of these companies fell a lot before even our stock market started falling. These Chinese companies started falling a lot because China started taking a heavy toll on their companies, and they didn't want them to become monopolies. So they got really, really fierce on them. But let's take a look at this article here. There are signs that regulatory scrutiny in China may start easing following months of clampdown on its tech giants, but its investors remain divided on what it can mean for Chinese stocks. Chinese stocks have bounced back following the release of Chinese state media reported last week, signaling support for Chinese markets and calling for closure on a 9-month-long tech crackdown. So they're saying they're easing off. The Shanghai Composite in mainland China remains 10% lower year to date, while the Shenzhen component has plunged more than 60% in the same period. So is it time to start investing? Well, let's see what this reporter says. Even after the rebound, we still see valuations as attractive. So prior to the recent bounce in China's markets, valuations had been close to a 10-year low. It's going to be volatile, but at the same time, it's time to start dipping our toes in. Management consultant Richard Martin, on the other hand, warned that China is investable, but a policy controlled market. So basically, when you put money into this market, please understand that you are taking a big risk that, another policy such as this can come out and your money is going to be put into some sort of fluctuation where you might not be able to get your money back just like you thought you were going to get back. Yes, they have a bigger economy than ours. Yes, they're supposed to surpass us in GDP by 2040, but that doesn't mean that their government can't, change their mind again next year and then their stocks plummet 80% all over again. So just know you can invest. Just make sure you've understood the political policy wins, Martin said. Meanwhile, Michael Yoshikami from Destination Wealth Management said it will be a tough road ahead for Chinese firms as the regulatory environment remains uncertain. Just because they said they're going to have some sort of foundation built for Chinese stocks, I still think the Chinese government wants things stabilized. Investors are now also watching for moves on the policy front in China as Beijing seeks to meet its gross domestic product, like we talked about, GDP. We expect China's policymakers to be proactive in supporting growth from here. On the macro front, in the coming weeks, we now expect both an interest rate cut and a reduction to the reserve requirement for banks, as well as a strong increase in fiscal spending support for the economy. So I really think there's a correlation here between what's going on here in China, as well as what we experienced in Russia, like the things that are going on in Russia and what's going on here. I think there's some sort of correlation. Matt, what are your thoughts?
So can you invite me? I'm backstage. All right.
There you go. No audio though. We can't.
All right.
There you go. There he is.
You hear me now?
I can hear you. We hear you.
Okay. Let me turn you up. I don't know. Kick this one off. Kick this one off for me. I want to hear what you think about this.
Well, I think their stocks were way oversold, especially from the spots they were at. Being that their economy is so much bigger than ours, GDP is going to grow there higher. I'm not saying that they're going to become the world's leading currency and they're going to become the reserve currency of the world. But what if it does happen? If it does happen, the power of these companies is going to grow exponentially. And with that, the value of your investment will grow exponentially if you invest in these companies. Right now, you have like the Uber of China, which is Didi. You have the Amazon of China, which is Alibaba. You have JD.com over there, which is kind of like Google. So you have these companies that you may have missed the boat on and getting on them on the ground floor here in the United States, but it happened over there. What I consider this to have what this year, and I'm talking about the last 12 months, the way I'm looking at it in China is that they just had their tech bubble, and their tech bubble just had happened. So historically, they've lagged us. They've lagged our economy historically. So what if they're 20 years behind us and they just had their .com moment where all their tech stocks plummeted? That's the way I'm looking at it. And Amazon fell 80% during the .com bubble. A lot of people were speculative on that, and they're like, we're not going to invest in this, and it fell 80%. Same thing just happened to Alibaba. So was that a moment to invest? What do you think, Matt?
I can't call you out on that analysis. I've heard that before. Not now, the tech is new to me, but I've heard I've heard other analysts say they're 6 months behind us, right? Or I'm sorry, let me rephrase that. They're 6 months ahead of us. And the reason people were saying that is because of Corona. They were the first to shut down. They were the first to reopen. Now they're going through a second shutdown, and we went through our second. Now they reopen. Now they're about to go through their third. I heard other comparisons where they're roughly 10 years behind us, right? You talk about the tech bubble, but a lot of people are talking about the real estate bubble. They're having their 08, 09 great financial
Recession.
crisis.
Yeah.
Right. But right, you got the Evergrande collapse. People, they still don't know if Evergrande is going to continue to make their payments. And it's not just Evergrande. There's other man, what do you call them? I want to say real estate entities that are also in trouble. They're too levered, and even just with the culture. I heard the other day that they don't like used houses. It's like a bad luck thing. They don't like people in their feng shui, if you will.
Yeah.
They like to buy new houses, but then again, I don't know why you would buy it. Who would you sell it to if that's the culture?
Yeah.
But
You're right.
nonetheless, I heard it, if they could afford it, they would never choose to own a house that somebody else, and that essentially it creates, with that mindset, it creates waste, right? So you're building a lot, but who's gonna occupy the these units? So
Uh, I mean, speaking from like, because I know they think, 100 years out, so I know they think far ahead, and these houses may not be for them. It may be an investment where, China already knows. Let's say this is speculation for my part, but let's say that they know in their 100-year plan that 2035 they're going to change their whole stance and let us start investing there. So now Americans have the opportunity to go invest in China's real estate, which I'm sure they would pounce on, especially like millionaires and billionaires that we have here, and they want to diversify their portfolio into a growing economy. um, Now we're putting American dollars into Chinese hands, so that's just maybe something I could see them doing. I know they like to think really, really far in advance. But I don't know. What do you think?
I think that's a good analysis, but let's go with that theory. They tried that, right? And we see the ghost towns, right? These are major cities that they built up. Nobody's moving in there, and this is for future planning. But at the end of the day, if you build it today, people have to occupy it today. Buildings corrode. Um, and there's I want to say like a joint course, or economies of scale, right?
Yeah.
So if I'm in a city with 1 million people and we're all using a sewer, that brings down sewer costs. But if I'm only one, and literally it's like this in some cities, if I'm one out of 20 people in a city designed for 12 million and we have to share sewer costs, right? So it still makes it economical of how you're going to get to the future from today. And that's where I see them struggling. And from what I understand, they've been destroying a lot of these cities. Well, let me not say cities. I know Evergrande has been destroying a lot of their property, especially the ones that haven't been filled yet, right?
Yeah.
There is such a thing of being too planning or expanding too fast or thinking too futuristic.
No, you're completely right. But we'll drop the China topic now. It's a lot of we're speculating a lot now, to avoid a bunch of episode about a bunch of speculation. Let's just jump into things we know. And one of the things I wanted to talk about today, because it's relevant, it's really relevant right now, is the yield curve. And I wanted to talk about the effects and also how to invest during a recession, how the yield curve has predicted recessions in the past. So we got a few images for you. I'm gonna share. The first one is when you're looking at the yield curve. And so what is the yield curve? The yield curve is just basically putting the time frames of the bonds in American bonds into a linear path. And whenever this portion of the graph, the left side, is aligned with the right portion of the graph, this is not something you want to see. All right. Um, all that means is that right now, the 1 month bond is trading below 1.5%, as of this picture here. And up here, the 30-year bond is trading above 2.5. So what can happen in a flattening of the yield curve is when this drops or when this rises, and the level of both the 30-year bond, and the one that's looked at the most is the 2-year bond. The 2 and 30 are the ones that are looked at mostly, but this works for here as well. So if they line up, if it's a perfect line, that means that you're getting the same yield, the same return on your investment for 1 month and 30 years out. That's not something you want to see. Anytime that's happened in history, and we're going to look at it about a year out, 6 months to a year out, or even up to 3 years out, it has predicted recessions in the past. So just keep that in mind. So this is a line that looks okay. This line is okay. This line right here is not okay. This line right here means it's an inverted yield curve. What that means is that the lower end, the 1 month, is giving you a higher yield than the 30-year. So this is not what you want to see, because it makes no sense for you to have a longer term investment, 30 years, and not be receiving the same amount. All right. There's lots of reasons this could happen. I'm going to jump into something that Matt shared with us. Matt, can you go through this and explain this commodities?
So everything is cyclical, right? I think we get caught up, and I'm not really a fan of the chartists, especially how can I say this? Especially the shorter the duration, anything can happen, right? So a lot of I'll give you a quick example. Go on a little tangent. A lot of chartists were looking at the market for this year and giving their expectations on the market for year end, but they weren't planning for, a Russian invasion, if you will, right? And that's why I don't like year charts or monthly charts. I like ones that span decades, because it kind of captures all of that. Here, essentially, this is a battle, if I'm not mistaken. This is a battle between equity and commodities. So typically when stocks do well, commodities are more or less affordable, right? Stocks struggle when commodity prices, i.e., $8 gas. Where are you at? You're in Virginia?
Yep.
$450 gas comes into the picture, right? So that makes the cost of goods more expensive, not just for consumers, but for operators, the companies themselves. The stocks tend to go down, commodities go up. So that's what we're seeing here. And my biggest thing to George over these past few years, it's been years now we've been talking about this, George. It's crazy how time flies.
I know, man.
Commodities. I've been screaming, and he knows this. I've been screaming like a little kid jumping up and down on the table. Commodities. Forget Kathy Woods. Commodities. And we're starting to see that play out, right? And it might go back down, but trust me, look at this chart. It's going to be on an upward trend from here on out.
Okay. Well, there you go. You heard it. You heard it here first. All right. The next thing we're going to look at is the same thing as the 10-year Treasury constant maturity minus the 2-year Treasury constant maturity. And as you can see, there's a decline there. And this is as current as March 2022. If we drop below 0 on this chart, there you go. We can have this could be an indicator of recession. All right. So this is the 10-year Treasury constant maturity, 2-year Treasury constant maturity. And this is going all the way back to 1980, all the way up till currently. And as you can see, every time we drop below that zero, subsequently, right after, we had a recession. So right here, 1980, it happened. Leading indicator, we had one here. This was 1979. What was it? Black Monday or Black?
1979. That's in the 80s.
Okay. Oh,
Black
so it was
markets
19.
in the 80s.
Okay.
79. That's just high inflationary times, post Vietnam. Pretty much what we're going through now.
Yeah. So Black Monday, right? Was it Black Monday or Tuesday? We're here in
Black
1980.
Tuesday. I want to say it was Black. Was it Black? Damn. I want to say Black Monday. I think Black Tuesday might have been, or Tuesday might have been 1929. I want to say that's Black Monday.
So right here, you can see, it happened here, and then subsequently after, we had a recession. Here we see it right before the dot-com bubble. We had a recession. Here you see it happened right before the housing market crash, the Great Recession, as was referenced earlier, and it happened. More recently, it kind of happened, but there was a pandemic-caused recession, which happened really quickly. So sort of kind of indicates that we were going to go into recession, whether the pandemic happened or not. That's what I gathered from it. But history will tell you that following this will show you how to, handle a recession. So how do you invest during a recession then? One of the things I would say is whenever you see these green days, like the last week and a half has been all green for the stock market. Even crypto has been on a run. I would advise you to sell into strength. All right. If you have those stocks that have been lagging, they haven't been performing the way you thought they would perform, but they had a huge bounce just now, sell, take the gain. Yes, you'll pay some capital gains tax on it, but I think you would rather pay some capital gains tax now and have some money in your pocket. That way, whenever the stocks do fall down again, that you can just put some more money back into it, and let's say it continues to run up a little bit. That's fine if you lose a little bit percentage gain, but as long as you got some gain. If you are going to buy, if you are going to invest, you can do so as well. I'm not going to tell you not to, but do it in profitable companies. Do it in companies that are actually generating cash flow. All right. We have a lot of those out there. Find them. Right now is not the time to jump into the speculation train. The Russell 1000, the Russell 2000 is filled with these stocks. They're filled with stocks that are very speculative. They're not really profitable yet. And we can see the direct correlation between the underperformance of the Russell 2000 and the outperformance of the S&P 500, which has more of the boring stocks in it. And then read the prospectus. We've talked about it before. Read the prospectus. All right. One of the things, I'll bring back the yield curve. One of the things that can happen during this that I will mention is that there's some stuff called quantum theory and the observer effect. Basically the same thing, which means that by us observing these things here, it might make them or act differently because we're looking at them, and they're going to act differently because we're over here constantly observing them or waiting on them to show us what to do. They might not behave the way they normally would have in the past. So while this is a good thing to look at, like Matt mentioned, he goes back and looks at historical things. This is a good indicator of what's happened in the past. But just like any hedge fund out there, any manager, mutual, anybody that handles your money is going to tell you in their document whenever you're signing it, there'll be somewhere in there in fine print that says past performance does not. Go ahead, go ahead, Matt. Finish it off because
What is it? Past performance does not guarantee future results.
Yep. Past performance will not guarantee you future results. And it was funny because I just watched the latest episode of Billions, and they literally used that line in Billions. It was pretty funny. Okay. So there's something to think about there. This is just a Fed fund rate. And I shared this so you could take a look at what's happened in the past. All right. So let me give me a second.
So also too that I want to bring up something interesting about the yield curve as well.
Go ahead.
So when an analyst on CNBC pointed out that what increases the odds of an inverted yield curve is when the Fed hikes rates, right?
Yeah.
So there's a twofold, right? The Fed is hiking the the um the left end of the curve, and investors, right, out of the fear trade, they're investing on the mid to opposite end of the curve, and it causes the curve to tilt into where um the left side is higher than the right side, or um the 1 month, 2 month is higher than the 10-year, 20-year, 30-year, if you will.
No, definitely.
Um, so it begs the question, and this is like a deeper level analysis. It begs the question: how many rate hikes can we really have this year, right? Because does the Fed want to send the wrong message? Essentially, yes, correct. Does the Fed want to send the wrong message? That's what happens when you rate hike, and a combination of people going into the fear trade because the market doesn't like the rate hikes. Like so, almost in line with the observer effect, it becomes a self-fulfilling prophecy that we invert the curve. So
Yeah, yeah.
I don't. Yes, the Fed has, and that's always been my argument, right? And I could admit when I was wrong. I said the Fed wasn't going to rate hike at all, and they did, right? All right, cool. Let's see if it matters. Let's see how many times they can do it, and let's see if it can actually stop negative real rates, right? So I want to throw this out there. When we were experiencing high inflation in the 70s, I heard something about 7, 8%. They had to jack rates up to 17% to calm down inflation. There's no way we could do that in this environment. There is no, we're going through the same level of inflation, but we don't have the same level of debt that we had in the 70s compared to today. In fact, we have more. So how many rate hikes can they do? I don't think many. I don't think before we get another collapse, I don't think many.
But there are positives though. So don't just think that um, the Fed's doing this is going to be a negative. There are some positive catalysts that will occur from this. What will occur is that there are companies out there that are known as zombie companies, and these zombie
Okay.
companies will not be able to pay. You know, it's called the business cycle. All right. So the business cycle, the way it occurs is a bunch of companies go up, you have a huge bubble, but then after you keep going through the wheel, and there comes a time where these unprofitable companies can no longer sustain, even with investors. And once the investors start leaving, they have to end up leaving the stock market. Their stocks go to zero, and that's why I'm saying right now you may see a stock that you really love, and you think, this company is in the EV space. EVs are going to be huge in 2030. You got to jump on it right now. But if this stock is not making money, this company is not making money, they might not make it to 2030. They might not make it to 2035. So keep that in mind. Don't put all of your eggs in one basket. You can have some speculative stocks inside of your portfolio, but you shouldn't be all speculative. Even if some people say you should be like 80-20 when you're 18, 19, but why take those losses? You should, balance out. Your speculative should be very, 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 very small. Anything different there? Like, how do you look at it, Matt?
I think that's sound advice, but my thing is this too. We're essentially we're separating the sheep from the wolves in this economic environment that not the one we just came out of, because as humans we could only think about what we experienced in the past, right? For better or for worse, we make all our decisions based off our typically recent past. That doesn't guarantee the recent or the near term future or long term future. With that being said, why can't you invest in commodities that all EVs have to use, right? You can't make a EV without copper. You can't do it without nickel, right? I can keep going. You can't do it without silver. So why not invest in these commodities that they have to use and or will be fighting over? I think the biggest secret in the EV community, and this is not publicized, Tesla is not selling millions of cars. It's not because they don't have the interest. It's not because they don't have the demand or the money. There's just a bottleneck on the commodities. There's only so much nickel. There's only so much um, copper out there, right? But before you start affecting other industries, there's not an endless supply of this stuff, right? It's a great concept, but my biggest fear, and this is from somebody who was invested in the EV space from 2013. The biggest struggle for them, they'll never admit it because then there'll be a run. But if you listen closely, you hear Elon Musk saying, "Hey, I'm gonna buy a nickel mining company." Right? There's a shortage of this stuff, man, and it's not just the car industry, the medical industry, the utility industry. They're all going after the same commodities. That's the problem.
Nah, and you're right. So basically, what Matt is saying, to put it in different terms, just an analogy that I'm sure you may have heard or may have not have heard, but back when the gold rush was happening, you know, some people said, "I'm not going to invest in the people going to get the gold. I'm going to invest in the people that are selling the shovels for it." You know, so it's just another way to look at it.
That's true.
So,
That is true. That's true.
and I think a good bringing up the commodities is a good segue for our next topic. So let me share that real quick. The next topic is investors are piling into gold ETFs facing a surprising tax bill. So basically, you know, do you want to invest in the ETF, which is the derivative of the gold, or would you rather invest in the gold itself? So let's talk about it. Exchange traded funds backed by physical gold are taxed at a higher rate than stocks of gold mining companies. I didn't know that. This is news to me. Matt probably knew that. But gold exchange traded funds, ETFs, are one of this year's hottest investments, with war, inflation, and stock market volatility sending people scrambling for safe havens. But those buying physical gold ETFs may face an unexpected tax burden. Funds that invest in precious metals like gold and silver are treated like collectibles for U.S. tax purposes, meaning long-term capital gains from those funds will be taxed at a top rate of 28%, compared with a maximum rate of 20% for stocks. This could be costly for investors who decide to cash out after a recent rally in gold prices, which hit a peak of over 2,000 an ounce earlier this month. I'm up more than 20% from a year ago. So I didn't know that, Matt. Did you know that?
I did, but you also missed my money dance.
I have.
Sometimes you got to bring back the Johnny Manziel. But no, also too, I would love to borrow your hat because it's partially cap. It's true. It's true. But I'm gonna tell you where the cap comes in.
Okay.
There's a lot of states right now vying for gold and silver to be treated as currency. So there's some states in the union right now that allows you to buy and sell gold and silver tax free, right? So not necessarily in the Northeast, not necessarily in the Northeast. I think you have to clear a threshold of over $1,000 in order to sell tax free. But there's other states in the union 100% tax free, and it's growing. I want to say Arizona is one of them. I think Texas is one of them. So, but then again, I'm assuming that's the federal law that's being applied. So,
Yeah. So it's from the IRS.
but nonetheless, I would still make the argument. Okay, fine, right? You could always move, and then this is the beautiful thing about precious metals that you can't do with real estate. That You can do it. You can do it with stocks, but you might have a harder time depending on the stock. You can move it across the borders. There's nothing stopping you from selling your gold or your silver in Canada, right? Or going to Mexico, or going to another I guess first world country, if you will, and just selling it, right? You have friends in Japan. There's nothing stopping you from coming over here and just selling your stuff, man. There's always a way to circumvent the system. So
I know, man. Talking about Japan, did you see this hat?
I figured. Yeah, Okinawa. It's the Okinawa. The
Yeah, it's the
Okinawa. I don't know if they dogs or.
yeah, the shishi dogs. But I had to put
Yeah,
on I had to put it on, you know.
I
All right,
see.
so here's just taking a look at is a chart that shows people pouring into gold ETFs this year and how much money has been going into these. You can see the return here: 2.5 billion, 1.3 billion, 4.3 billion. So a lot of people are going to try to sell here in this area, and they may not have known. I told you I didn't know. This is a good lesson that you should, whatever you're invested in, know the tax implications for it. People that trade options, they don't really understand the tax implications for options. They might think it's the same as stocks when really it's not. Traders have to get a certain code and become like self-employed in the IRS eyes in order to get more benefits from it. But if you're just a options trader on Robinhood that does it like once a day or once a week, whenever you're taxed on it, even if you are making profit, you're going to be taxed a lot higher than these people that do it as a full-time job, the full-time traders. But that's just a lesson learned. It's sometimes it's better to invest in the actual mining company than the gold ETF. But I'm sure Matt would argue that he would rather invest in the commodity itself, the actual physical, than invest in the ETF or the options, the
So
whatever
so
company.
so whenever we talk about the physical versus the paper, this is the paper stuff, man, right? And it takes away the whole essence of investing in the metal in the first place, right? Because at the end of the day, if they don't have the metal, it's in the prospectus. If they don't have the metal, they can cash you out, right? They can settle you in cash. So again, what's the point, right? You're so convenient to the point where it's at a detriment to yourself. It's like me saying, man, I want to diversify my portfolio. I'm in the equity, I'm in the paper. Let me diversify. Let me get a gold ETF. You might as well say, hey, the Hummer miles per gallon is terrible. Let me get an Escalade. No, man, like that's still a gas guzzler. Like you
Right.
wanna you a house. I don't like the valuations, but at the end of the day, it's a tangible asset, right? You can't confuse that with a stock. You can't confuse that with a crypto. Like that is a tangible asset. There is that house is made of nothing of commodities. Even if you gutted your house and you just want to own the land, you can still resell the commodities that went into building your house. The tangibleness you can't get around. A gold ETF, man, it doesn't do any. It not only that, not only does it potentially hurt you, it hurts the community because they could promise to buy your gold with your ETF money, but there's no way of tracking that. There's no
Yeah.
way of really verifying it. Whereas you could take your money and you could put a dent. You could literally put a dent in, physical gold and should buy it, keeping it, putting it under the mattress.
And there's always that, like, if everybody did go take their stock and go try to get that physical gold exchange for that stock,
Ooh.
that there wouldn't be enough gold to give everybody back, even though they paid for it. And going back to the tax rate, the reason for it states here that it's because these ETFs are backed by physical metal. Their shares are treated the same way as stamps, antiques, or gems, and that's why they're taxed at the 28% tax rate, vice the 20% tax rate that stocks are capped at. All right, so we'll move on. So we're talking about here what are Americans invested in, and it says here nearly half of Americans are invested in stocks, which I'm sure is a big difference from 20 years ago. A lot has to do with the commission-free trading, and the more it's televised. This meme mania had a lot of people in it. The pandemic gave people not a lot to do, but put money into investments like a gamble. But there's a risk in losing your investment if the company does poorly. Something important to know. It's important to understand how stocks work, what you may own trades, and which stocks are the best fit for your risk level. Also, like we just talked about, what are the tax implications for what you're doing? If the company does well, there could be short or long-term capital gains tax on the appreciation if you sell. There are a multitude of choices, and it takes time to research to understand what stocks fit your risk tolerance and how to build a diversified portfolio. Doing research is not going on Reddit and looking at what everybody else is talking about. I repeat, doing your research is not going on Reddit and seeing what everybody else is talking about, what stock to jump on. I repeat, do not go on Reddit looking for your stock, the next stock you're going to buy, because by the time you looked at it, if you go look how many views are on that, there are probably 10,000, 20,000, 30,000 views on that, impressions or whatever you want to call it, on that stock, that are probably jumped in it way before you did. So just keep that in mind. By the time you jump in it, there are already people that are selling out of it. So don't be a fool. Do not get your investment advice from threads on Reddit. All right. Matt, you agree?
Man, I mean, that's like sweet music to my ears. Like, I have so many friends, they jump on the Reddit page and they go with that wave. But let's talk about AMC. How they doing? I remember they thought they had the game locked.
Talk about it.
One guy was so kind. He was like, it's a short squeeze. It's a short squeeze. The only way that this thing could go is up. And don't get me wrong, it did. But these guys wanted to go to, 4 digits. We talking about multiple in the thousands, right? And there was no light bulb moment, if you will, of damn, maybe they could split the shares, or maybe they could issue new shares, which they did, and just diluted the whole freaking stock. Because at the end of the day, these are not finite resources, right? That's the problem with paper assets. They're not fine. They could repurchase and reduce the quantity, but they could also issue and multiply the quantity. So you're 100% right. It's not bad to put your ear in the streets and see what people are looking at, but that can't be the only source. That can't be the
Oh,
only
right
source
here,
of information.
this is
It's
the
bad
6-month
news.
chart for AMC. Right here, let's look at the 5-year chart. This is when that squeeze happened. Right here, you can see the craziness, but ever since then, it's been lower lows and lower highs, and that's the epitome of a stock you don't want to see. Look what this stock did historically. All right, even before the whole like phase or whatever, the highest it ever got was right here around $31, and this was back in 2017. Ever since then, it's dropped. They've had a lot of competition from Cinemark and other companies, and know what you're talking. I don't even invest in the stock anymore. But before I did, Matt knows I did it before the meme mania, and I had done research on it. It was like $2, and I said, like we talked about, having a certain amount of your allocation in speculative stocks. I didn't take everything I owned and put it into it. I bought 400 shares because it was really cheap. I told Matt, hey, you should look into AMC. And next thing you know, this thing shoots up to, what was it? Let's see the high, about $72. But the crazy thing is that there are people that were buying here. All right. There are people that were buying this high. Ever since then, it's dropped down. We can see this in a multitude of different companies. All right. Another one. This is one that Matt and I literally know somebody who invested in it at like one of the high peaks. Here you have Nikola. Let's look at the 5-year chart for Nikola. Here we go. They announced the merger. It jumps up. They actually merged. This thing jumped up, flew up all the way up. We knew somebody who bought right here in like the $80 mark in Australia. I don't know how much he spent on it, but he invested like he thought he was healthy. And then next thing you know, it got down here, and he's like, I bought some more. And that's what's called catching a falling knife. All right, because what happened next? Continue to fall. Then they got some news that they were lying on their advertisements. They dropped some more. People are still buying in this area. Oh, I'm buying the dip. Nope, buying the dip. Nope, lower lows, lower lows. Even recently, they had some good news because they're finally now, over a year later, jumping in and actually investing it. So if you could look at the last 5 days, we actually had a big bump. And guess what? People bought up here again, fell for it once again, and now we're down here once again. So even though it's up today at $9.72, right now is not the time to invest in it. The low today, like just look at the chart just in one day, the different fluctuations. Knowing what you're investing in is very important. Like, we want to save you money. Accumulating cash is also important, but preserving that cash is always one of the things that I want to do the most. And that's why Matt does the same thing. He does it with gold. He does it with physical silver, physical gold. And that's how he preserves his wealth. I do that as well, but I also am in the stock market and crypto and preserving it by doing my research before I invest in things. Try to get ahead of the things that you're going to invest in. You should have been in the gas prices, in the gas stocks before everybody else jumped in. The moment, like, Russia even made a suggestion that they might invade Ukraine, you should have been on that day. Even though it jumped up a little bit, that would have been your perfect moment. You would have gotten a huge gain. But the time to do it is not now. Because not saying it won't go up. It could go to $400 a gallon. But think about the more likelihood of what's going to happen, and then is the risk reward worth it, or could your money be put somewhere else even better? I'm not, again, in these last 2 weeks, I haven't bought anything. The last thing I bought was 4 shares of ED at about $1.81 per share, and that's sitting at like $4 per share. And I'm at the point where I'm about to sell it, even though I want to keep it long term. I think it's run too much in the last 2 weeks. So I'm going to trim my position, at least take my money back. But I just wanted to share these charts, let you know that, trying to give you a depiction of what we're talking about. Matt and I were not financial advisors, even though I think he might be. He's close to that. But I'm not your financial advisor. He's not your financial advisor. But what we're trying to do is give you tools for your toolbox and try to make you be the most effective investor that you can possibly be. That's my goal. I know that's Matt's goal. It looks like you're in Swiss Beats and Alicia Keys' house behind you.
I had to switch it up. Once you put the gold on, I had to,
It looks clean. It looks, no lie. If you didn't move your hand, it looks natural. It looks like that's your living room.
Listen, I got this from SteamYard. You know what I'm saying? Got this from SteamYard. I want to be a complete fronter.
I should put it up too, so people get really confused.
Yeah, like, they in the same house in the same spot.
But Matt, we're almost at an hour. Like, any final thoughts for the viewers?
Yeah. I just want to do a quick round. Smash or pass. So stocks in 1 year.
So this is what he's talking about here. Smash or pass.
There it is. Let's do it.
I'm bullish. I see the end of the year to date. On December 31st, or the last trading day of the United States, I think we will be at S&P 500 at $5,100 per share.
Okay.
That's where I see it. That's about 15% increase from here, I believe. 15 to 20% increase from here. One of the big things is that a lot of the things we've concerned about, we have phased it out. And I think that even though in May, when the Federal Reserve does drop, I'm pretty sure they're going to drop the interest rate down even more. I'm fairly certain they're going to do 50 basis points, which is half a percentage. They're going to bump up the Fed fund rate. This affects your savings accounts, and this affects how much people are getting charged for borrowing money. Tomorrow we're going to talk about housing. So but I think a lot of what the Fed has done has been priced in, and I foresee that in November, I think is going to be the final rate hike, which will put us at the Fed fund rate of 3%, which currently we're at 50 basis points. I think once we hit that, it's going to be a bullish trigger for the market. Once the market knows that we're no longer going to go up any higher, I think it'll be a bullish trigger for the market, and we're going to end the year on a high note. But what is your theory? You asked the question. What do you think, man?
Yeah, I think one of us is freezing, but I think you're doing one of these right here.
Oh
yeah, yeah.
I'm like Akon.
I feel like
don't smoke, don't drink, cause I don't be by the bar, baby.
Oh nah, you in the bar, you in the spot. I'm about to give you an ashtray. No, and I think that's the funny thing. I think I'm gonna speak fast. I think we might come to the same answer, but I think different reasons as to why. I think if the market goes up, I think no doubt in my mind it's a hyperinflation, right? Historically low rates, inflation out of control, more stimulus to come, lack of commodities. It's kind of screaming towards the inflation, and if we're not careful, hyperinflation, and yes, you will see the market outperform, but that doesn't matter if the value of your dollar is just decreasing more than the market is performing, right? So that's the only way I will personally give credence. I don't think this is a quick turnaround story. That and 3%, dude, on the short end of the yield curve, I would love to see that. That would let me know we're a lot more healthy than we are, right? Keep in mind all the debt that's out there, right? Keep in mind all the years of low interest rates. Now we're just gonna go to 3% in 1 year. You already, and I don't want to ruin your show for tomorrow, but you already see the housing market starting to act up, right? We'll talk about that tomorrow, but
we're also going to talk about stagflation. I want to bring stagflation into the mix and talk about that a little bit. But hey, that's all I got. That's all you got, Matt?
That's all I got.
Hey, as always, invest in us and press that like button, invest in yourself, and smash that subscribe button. It costs you literally nothing. Matt, thank you for joining me as always. You make the show so much better with your insight. I love you, bro. Until next time.